Everything is rising. If we look at the stock market, it's shooting high, the SP 500 especially. If we look at the housing prices, it's shooting up. If we look at prices in general that you pay for food, for anything, everything is rising. And people just say, just take some part of your passive income and invest it on the stock market, and eventually it will go high. The people who predict there is a crash, they will always be there. They will tell you there is a crash, but even if there is a crash, it will recover and everything is okay, everything is rising all the time. But there are market cycles, and even much more than this, should we just believe people who tell us do this, do that, or should we self-investigate? So after doing some self-investigations, this is what I think. I think we are looking only at prices of market. And because we are only looking at prices, we will see everything that is rising. House prices will rise. The amount of money in the market will rise. The stocks would rise. So everything is rising. Is this a dream? I mean, you just take some amount of your monthly income, put in a house or invest in stocks, and it will continue to rise, or not a dream? So basically, it's not a dream. However, the lifespan of a human being is a few tens of years, and in these few tens of years, we don't see the whole picture. For example, now we are living already in 10 or 15 years of very low interest. And it doesn't make sense that it would get higher, because this is what we're used to. We see the housing prices shoot up. We're getting used to it. We think that this is the state, that this is the state of reality. But it's very easy to be tempted into believing all this and not thinking that there could be a different reality where interest rates will rise, a different reality where inflation will rise, a different reality where stock prices will not rise. Okay, so we don't really know. It's impossible to know this, and this is why Harry Brown said we should allocate 25% to metal, to gold specifically, 25% in cash, don't do anything with it, 24% in long-term bonds, and 25% in stocks, so that you are ready for any market condition, inflation, deflation, stagnation, and growth. So this is practically a good approach. And the good approach says that we don't know. We don't have the ability to know. There is no chance we would know. So we just spread things for any condition, taking into account we will lose some, we would gain some, but overall we will grow with the overall market. This is a very good approach. Some can claim that saying that 25% allocation in cash is crazy, because cash is not doing nothing if not devaluating. In general, I agree that this is correct, because the amount of deflation that we have is very short. But I think this gives people a few good things, because they have spare money to use and to do things with, and in case of a crash, you can take some portion of this 25% and move it to better allocations. Stocks, for example. And some people say that 25% in gold is also crazy, because gold is overpriced. Gold is nothing. It's not a company. It's not doing anything. But actually, I think it's also a good thing, because gold, I think, represents the true money. Cash is the immediate money, and at least as of today, I don't think this would change in the near future. Gold is one of the best representation of true money, and not paper money, which devaluates. Gold is not supposed to, there is no chance. It's just not going to happen soon. So treat gold as money. If you have if someone has spare, if someone wants to, because if you make, so the thing is this. If we look at stock prices and at finance, we see them keep getting higher and higher. So it's very hard because of this reason to understand if there is going to be a crash or there is going to be a downside, because we just see them getting higher and then crashing sometime, and then getting higher, then crashing. So after doing some research, it looks like a better way to look at things is to compare them with ratios. So what we could do is take, let's say, SP 500 and compare it with, just divide SP 500 divide by gold, and then you get some ratio. And the nice thing about ratios is that they don't really care about the specific price, because if both are growing, the ratio is the same. If one of them is growing and the other one is stagnating, then the ratio gets higher. So you can look at the ratio from 0 to 1 and say, actually it could be higher than 1. So you look at the ratio and you see the fun thing is that we see very nice cycles when we do ratios, and we can do ratios in between everything, and we see very nice cycles in between all these things. And once we see, I mean nice cycles because we can see it actually going up and down and up and down, versus if you look just at stocks or things like this, which are always going up and with a crash. Also, if you look at the gold price, you will see it always going up and then crash. But looking at ratios, let's compare the ratio of uranium to gold, the ratio of gold to SP 500, the ratio of platinum to gold. Once you do all these comparisons, you see cycles, and then you can identify things which are cheap. They are not cheap because their price is cheap. They are cheap because the ratio is cheap. So this is, I think, a big understanding about the market conditions where the finance is going, is to look at things where we have true cycles. We don't see these cycles in the prices. We see these cycles only if we do ratios. So we take many assets or asset classes and we divide them by one another, and then we see the ratios. And then it's very clear what is priced and what is cheap. As of today, I'm sorry to say that the SP 500 is overpriced. It could stay the same, it could go lower, it could go higher. Let's see, we have no way to understand. But the thing is this, with statistics we can say that there is a higher probability that the things that have a lower ratio will rise more than the things that have a higher ratio. It's just probability. So I think when doing allocation with the Harry Browne portfolio, there is some tweak that we can do. I don't like tweaks, nobody knows the future, but we could maybe allocate a little bit more to the assets that have a lower ratio. And what is having a lower ratio today? Uranium, platinum, gold, and silver. Those are underpriced today. The ratios are low. Add to this that we are going to have a real estate market boom. Add to this that there is a potential of an increasing interest rate. Add to this that there is a potential for dollar decrease, depreciation, and we might be headed into a commodity boom. A commodity boom means that commodities such as gold, silver, uranium, and platinum, and also oil and copper are going to boom. This is not advice, this is just personal opinion based on looking at things. Do the research yourself, but this looks like a plausible scenario. And if it's not a plausible scenario, then plan B would be to allocate in between the different assets and allocate a little bit more to those that have a lower ratio. So I hope you found this interesting. I surely did. See you guys next time.